If you have a non-US brokerage account, which probably holds mutual funds, you need to watch this video so you understand how PFIC can apply to you. I have another video on PFIC that dives into the different types of rules, which you can find here. In this video, we're going to be talking about a specific client situation who was a client from India that moved to the US with a brokerage account, fell into these PFIC rules. We're going to talk about what would have happened if he hadn't planned accordingly and what we were able to do to save him some taxes and save on the PFIC situation in general. So in this situation, this was an individual from India that moved to the US during the year, and they had lived in India all their life, Indian citizens, families in India, brokerage account, and some assets in India, then moved to the US. So as we all know, the US has a worldwide taxation system. So once he became a tax resident in the US, in this case through what's called the substantial presence test, so they spent more than 183 days. The rule's a little more nuanced than that, but that's what triggered his tax residency. So now he's got to pick up his worldwide assets. So reporting it on FBARs and picking up income on worldwide assets. The brokerage account outside the US, or in this case, India, causes major problems with what's called passive foreign investment companies, or PFICs. So this rule came about as a backstop to the controlled foreign corporation rules. So basically with a controlled foreign corporation, if more than 50% of a foreign corporation is owned by US people, then the IRS has some leverage to hit you with these anti-deferral rules, subpart F, guilty, and things like that to make you pay tax on income that you haven't taken out, so you can't just defer the income forever. The problem the IRS saw was that if it was not a controlled foreign corporation, people were setting up, say, a Cayman Island company to own foreign mutual funds, foreign investment assets, and in that case, not a controlled foreign corporation. If you're liking this video, you should really check out my newsletter where I put out different tips and tricks, latest law changes that can really help you save money and save complexity if you're living or investing abroad. Just think how much you could save with the right tax advice. Then you could defer taxation forever until you decide to bring it back. So the IRS shut that down, and this was back in the 60s with these PFIC rules. The problem is, unintentionally, the PFIC rules apply to these brokerage accounts and these foreign mutual funds, because by definition, a foreign mutual fund is a foreign corporation, and all it does is earn passive income. So it falls under this passive foreign investment company rule. So in my client's example, when he moved to the US, he's going to be subject to what's called the excess distribution regime. So he's going to be taxable in the US on dividends and sales of that asset at a 37% tax rate, the highest marginal income tax rate in the US, plus an interest charge over the holding period of the fund. Very bad answer in that scenario. What we do is we looked at it and applied what's called the mark-to-market election to this fund. So in this scenario, let's assume my client has an Indian mutual fund or a brokerage account in India, moved to the US on January 1st. So if he purchased that fund for $100 and he moved to the US on January 1, 2024, let's assume it's worth $150 when he moved to the US. And then at the end of 24, it's worth $170. So in a general scenario, this excess distribution regime is going to subject him to a 37% tax on the gain when he sells it. That's a very bad answer, or on a distribution. That's a very bad answer. So what we did is we made a mark-to-market election on the fund so that going forward, he pays tax on the appreciation of the fund, regardless of whether he takes money out. But then when he does take money out, it's not taxable. And that mark-to-market piece is only taxable at his marginal income tax rate, which was much lower than 37%. The nuance to that, though, is that we have to make sure he also is getting a credit in the US for the Indian taxes paid. And that's something you can get in trouble with the mark-to-market election, because you can mess up the timing between the two. For example, if in year one, he didn't sell anything in the fund, or he didn't sell the fund at all, and we had appreciation in that fund of $100 and he pays tax on that, next year, let's say he actually sells the fund, he's going to pay tax in India, and now we have a mismatch in the years from a mark-to-market election. So in this client's case, he had several mutual funds, so it wasn't just a one fund scenario. If it was a one fund scenario, honestly, what I'm telling my client to do is, let's get rid of it before you come to the US and we don't have to deal with PFIC at all. That's objective number one, as far as PFIC planning goes, is get rid of the thing before you become a US person. In this case, it was a little too late. Andy owned a bunch of them. So what we did was, in this mark-to-market election, we made sure that he realized income in India at least equal to that mark-to-market election amount, so that we could take that foreign tax credit and basically match up the timing of the Indian taxes with the US taxes. PFICs are very confusing. It's one of my least favorite things to deal with because it's very hard to explain to clients. In most cases, extremely unfair and not intentional really from an IRS perspective. It just lands in these mutual funds and causes havoc amongst the entire international community. If you're a US person, if you hold foreign mutual funds, foreign brokerage accounts, especially if you're not a US person, you're looking to move to the US, we need to get rid of those foreign mutual funds now before you do, or let's plan for it in advance with a mark-to-market election. There's also a QEF election that we can make in some cases that gives you an even better result. But at the end of the day, you got to know you have a PFIC, and then if we can get rid of it beforehand, that's best case scenario. Otherwise, we're managing it with certain elections and making sure you're paying as little taxes as possible. If you have questions about PFICs or foreign mutual funds or how that might affect your US taxes, reach out to us at McGowanTax.com. I would love to set up a call with you personally to talk through it and see how we can help your situation and help you save taxes. You can also leave a comment here. If you're moving from India and have questions about specific Indian mutual funds, please leave a comment about what you're dealing with, questions you have. I'd love to answer them right here, or reach out to us at McGowanTax.com, where you can schedule a consultation with me. Thanks for watching.